Welcome to our post-budget roundtable. In this session, we're going to be taking a closer look at what the latest budget means for contractors, small businesses, and the wider financial landscape. We will be joined by experts from across the Danbro group, who will be sharing their insights on tax changes, financial planning, and umbrella employment impacts, and what clients should do to prepare now. Hi everyone, welcome to our post-budget roundtable. Today I am joined by
Liam Winstanley, Director and Chartered Financial Planner for Danbro Financial Planning.
Talha Saudi, Client Partner, Chartered Accountant and Chartered Tax Advisor.
Michael Howard, Head of Agency Sales here at the Danbro Group.
Daniel Broughton, Head of Umbrella at the Danbro Group.
So we are here to break down what the budget means for clients. So let's jump straight in. So Liam, what did the changes to pension salary sacrifice mean from 2029? And does this mean salary sacrifice is dead for pensions?
Okay, so it's probably wise to put this into some sort of context. Salary sacrifice has been around for some years now, and essentially it allows employees to give up part of the salary in exchange for a pension contribution. And the idea behind it is that they save income tax and national insurance on that as well. So what the government have actually done is they've said, okay, it's unfair that some people can get national insurance relief whereas others can't. So what we're going to do is we're going to limit the amount of national insurance relief that you can have on a pension contribution. So it's really important to say this is not an end to salary sacrifice. It's not an end to pension salary sacrifice. What it is, it's just simply a cap on the amount of national insurance relief that you can get on a salary sacrifice arrangement. People will still be able to put more than £2,000 into a salary sacrifice arrangement, and they will still get full income tax relief on that as well.
Okay, perfect. Dan, have you got any notes?
It was just off the back of that, Liam. So the biggest thing that stood out to me with that is obviously a big shock, but they said from 2029. So do you think we should be doing something now, or do you think it's going to happen if there's a new government? I'd like your thoughts.
Yeah, good question, Dan. I mean, you can only do what's here and now in the present. So, generally the advice around that would be, look, whether that measure came in today or tomorrow, if you're doing pension salary sacrifice, you probably just carry on with it because it's still the most efficient and administratively effective way of putting money into your pension as an employee. Again, one of the reasons for that is particularly if you're a higher rate or additional rate taxpayer, you have to claim the additional relief back through your tax return if you don't do salary sacrifice. So there's still a lot of benefits to doing it, a lot of tax reasons to do it. Will it happen? Well, it remains to be seen, doesn't it? I mean, it's a good few years away yet. So, I'll be interested to see what other people think about that. My own thoughts is it probably will happen, but I wouldn't be entirely surprised if it was a bit of a pre-election sort of giveaway in the next lead up to the next election. Okay. Yeah.
So I thought I'd just add as well, it's just to clear up, it's not income tax charges on it, it's just the employers and employees and ICs. So you're talking every £1,000, depending on what your monthly salary is, the employer would have to contribute £150 and you as an employee would contribute £80 or £20 if your salary is over £5,000 or £4,000.
Perfect. A question for you, Saudi. How does the budget impact my business?
So there are a few implications from what's been updated. So I think the first biggest one that a lot of people were worried about is there are no VAT changes, which is a massive thing. So the rumour was that initially people were expected businesses over £30,000 turnover were going to have to become VAT registered. So you don't need to worry about becoming VAT registered. Those thresholds have not changed. I would say the biggest changes are towards the minimum wage limits. So any employees under the age of 20, their minimum wage has gone from £10 to £10.85. National living wages for anyone over 21 is now £12.71. So that would probably be the biggest impact to the day-to-day businesses. They have also led on the budget as well to say that they are trying to help with business rates for high street retailers. So they've not really gone into much detail on that just yet, but it's worthwhile noting that business rates will be likely coming down for high street retailers.
Okay, perfect. Has anyone else got anything they'd like to add? Okay, all right. This question is for you, Michael. What impact will the joint and several liability have on my business?
Yeah, it's probably a hot topic at the moment, especially across the Danbro umbrella brand. It depends what business you're coming from, Sophie. So if you're a recruitment agency, clearly the joint and several liability will have an impact on whether the supply chain will deduct the right amount of tax and national insurance. And if there's a shortfall, it means that joint and several liability will move up the chain to yourself. So as an agency, if that's your business, you need to make sure you've got stronger processes. It means you've got stronger partners. And also you need to make sure that you've got better due diligence up and down the supply chain. If we suggest that you may be an end client, again, very similar sort of rules apply. If you're engaging directly with the likes of Danbro or an umbrella company, and there's a shortfall with umbrella companies in the supply chain, then you as the client will be jointly and severally liable for any shortfall in tax or national insurance. I think the big one and the one that causes a lot of volume within our space that we've been speaking about is if you're an MSP or if you're a neutral vendor, you've obviously got even more challenges because sometimes you don't actually have the direct contract with the umbrella company. You seem to engage with sourcing agencies or suppliers, but you're the one holding the can should any umbrella companies have a shortfall in tax or national insurance. So a real consistent message around making sure due diligence is increased, making sure that the supply chain is tightened. But also, I think for me, this brings the industry closer together. So I think if you're doing a lot of things really well, you've got financial stability, and you can prove that the right levels of tax and national insurance is being paid, I feel that you're going to be in a great place going forward. So hopefully that's answered your question.
Yeah. Perfect. Is there anyone else? Yeah, Dan?
Yeah, it was one of those things that wasn't directly mentioned in the budget, but it's definitely happening in April 26 that everyone in the recruitment temporary contract space needs to be aware of. But what they did mention in the budget is this Fair Work agency. So it's all good with the liability and tax changes increasing the risk, but do we think the government are going to enforce it? That's kind of what this Fair Work agency is. It's a group of government bodies coming together for like a single enforcement group to actually look, enforce, comply, all of the tax underpayments, the workforce in general, to make sure that workers are getting their fair employment and the correct taxes being done. So it's important to note joint several liability is important, but it was even further explained that the government are increasing spend on an enforcement body to make sure that it complies well.
Okay, perfect. Michael?
Yeah, no, thanks, Dan. I think just to touch on that, I think just going back to the Fair Work policy, they've recruited Matthew Taylor, who was influential with the Matthew Taylor report back in 2017-18 when it came to reviewing sort of tax status, I-35 and all of that stuff that happened a number of years ago. So there's a level of experience in terms of how to tackle compliance, and we as a business that have been compliant for a number of years, working at the highest standards, see this as a positive change. So we welcome this change and we look forward to everybody moving forward in the same direction from April onwards.
Brilliant, thank you. Now a question for Dan. How will the budget affect the temp worker industry?
So I think Tala briefly mentioned it. The biggest impact for businesses is probably going to be the biggest impact for the temp worker agencies, which is the minimum wage increase. As much for everyone that's on the minimum rate, they're going to get increased pay, so they're going to be happy. But for project owners and clients, people trying to resource these projects, it's really just made it more costly to be able to do it. So I wouldn't necessarily be surprised that with all the extra compliance and risk that comes in, that businesses are going to be a bit more wary, and we're not going to see like a big uptake in hiring and temporary contractors. It's probably going to be a bit more cautious, a bit more steady. It'll definitely be a lot more fairer in terms of getting rid of all the fraudulent entities out there that are trying to undercut costs, which we're all for. But yeah, the minimum wage increase is really going to be a bit of a dampener and really make businesses consider what projects, how many people they hire, and whether they actually employ them fully or do use temporary contractors.
Okay, brilliant. Has anyone else got anything they'd like to add? Okay, so Liam. There you go. How will the 2% increase to savings and dividend interest tax impact savers and investors?
Okay, so I think this was a bit of a surprise, really. I don't think anybody was expecting this. There's been a lot of lobbying and a lot of talk about sort of equalising, capital gains tax rates, for example, with income tax rates, but nobody was expecting, increases to savings interest costs, savings interest tax costs, dividend costs, and rental income costs as well. So, how's it going to impact savers and investors in particular? I'll let Saudi deal with the company direct a bit. But how's it going to deal? Essentially, what people have to be aware of is, we still have a savings system that allows people to earn, as a basic rate taxpayer, allows people to earn £1,000 a year of savings interest before they pay tax, which, if you work on sort of a 4% interest rate, they'd have to have £25,000 saved. And likewise for higher rate taxpayers, they've got an allowance of £500. You've also got your ISA allowances, which are still used, which I'm sure you'll come on to later. So there are plenty of ways you can still shield your savings interest, in particular from tax. But it's going to put a sharper focus with interest rates going up. People who have a lot of cash savings, for example, have started to notice the tax take through the tax codes over the last few years. So I think it's been sharp in people's minds for the last 12, 18 months anyway. And I think perhaps what people probably need to be doing if they're in that situation is just taking a little bit more care over how they're saving and how they're investing, just to make sure they use the available reliefs and allowances that are there. The landlord one wasn't a shock to me, if I'm honest. Landlords seem to have become a bit of an easy target over the last few years. So yeah, I mean, adding 2% to rental income profit tax, that's not a surprise. Ultimately, a bit like what Dan mentioned before, I can see that just getting passed on to the end user, which is unfortunately the tenant at the end of the day. So, yeah, they're all revenue raising measures, but can you take practical financial planning steps to try and minimise it? Yeah, you probably can. So yeah, that would be my take on that.
Saudi, would you like to
add to that as well? Yeah. So I feel like with all the MTD changes, I feel like HMRC or the government is sort of trying to get people more leaning towards putting their rental profits for a limited company. Because if you think about all the compliance needs that are going to be necessary in the next 3 or 4 years, people with rental profits over £20,000 to £25,000 are going to be having to declare things on a quarterly basis. They might not be paying tax on a quarterly, but those compliance costs will get passed down as well. So again, as Liam was sort of saying, that essentially is all going to end up in the tenants' rent costs. I feel like they are trying to push people to go in towards a limited company. I think what you sort of need to bear in mind is when you do go a limited company is there would be a sort of double taxation issue to worry about at the sale of the property. The company would have to pay corporation tax on any gain it's made, and then if you are closing that company down, you're going to be liable at the moment to capital gains tax. So that is just something to bear in mind. So if you have got any questions on that, see if it is worthwhile to go limited, do let us know and we can talk through the figures to see if it is worthwhile to consider based on what your ideas are and your needs are for the company and the property.
Yeah, I think just adding to that as well, if you think, we receive quite a lot of queries over the last couple of years from existing landlords where they're holding the properties in their personal names, saying, should I put it into a limited company? Because the tax will be lower. It's not always the case because you need to be careful with that. There are issues around. You mentioned capital gains tax before, so when the property is transferred to a limited company, there's potential to pay capital gains tax. There's also stamp duty on the transfer as well. So it's not as simple as simply picking up the existing rental properties and putting them into a company, is it?
No.
No. So yeah, that's one thing we get asked quite a lot. Once people actually look at the costs and the potential complexities of doing that, they probably end up deciding, it's probably not worth it. But certainly for new investors and new landlords looking to do that, then certainly the limited company route does look to be getting more attractive, doesn't it?
Dan?
Just to pick up on your point on the quarterly submissions requirement, and you think the government are trying to push people to limited. So in the temporary market, we're seeing it's happening for self-employed. So people in the construction industry scheme are also affected to having to do quarterly submissions as well. Do you think that's trying to push them towards more limited, or? I don't know. I wanted to flag because it's not just limited companies affected, because it's anyone self-employed really over that threshold. So the construction industry scheme are having to get HMRC approved software to do quarterly submissions account, albeit probably very simple, because it's probably very simple income and expenditure. But yeah, do you think it's anything to do with construction particularly that the government are interested in?
So with the CIS scheme, obviously sole traders are impacted outside of being in the CIS scheme anyway. I think with the requirements for CIS, those submissions are having to be done on a monthly basis already, whether you're a limited company or a sole trader, in terms of declaring what, if you are the subcontractor, declaring what tax has been deducted from you, or if you are subcontracting the work out, declaring what tax you have deducted on behalf of your subcontractees. So I wouldn't say it's directly going after CIS, but they are also impacted as well, along with any sole trader really. I think that it's difficult because I feel like they are just trying to push more people into becoming a limited company, where more than likely, depending on what your level of turnover is, it's not worthwhile doing. If we go on to think about the amount of salary and dividends, obviously they've increased the dividend tax rate. If we're looking at what we would sort of expect, it's probably not as worthwhile as it used to be maybe 5 years ago. I know previously my sort of benchmark was, if your turnover was in the region of around £30,000, I'd say potentially worthwhile going limited. I'd say now it's closer to 60, with all the national insurance changes that have happened over the last few years anyway.
Okay, so Sada, we've spoke about the impact on property tax, but how would it impact personal?
Personal tax. So obviously dividend tax rates we've mentioned has gone up by 2%. So I was doing a bit of maths on it. If you are a basic rate tax rate, so let's say you are an owner managed business, your income from the companies, you're talking your basic salary of in line with your personal allowance, and then the rest of it is taken up by dividends up to your basic rate. You're talking an extra cost of nearly £800 of tax of income you've not additionally taken out. It's just, that's your increased cost in the year. So I think that is the biggest one. Obviously, though, those changes are coming into play from April, so it is something to think about and is worthwhile thinking about. Obviously, there are ways of, if you are exceeding your basic rate tax, that we can consider, mainly being still pension. If you are privately putting money into a pension scheme, and this is outside of the salary sacrifice implications that we've already discussed, we can look at increasing your basic rate band and seeing if that is worthwhile. Another method again is like if you're already putting money into a charity via gift aid, that's another route that we can consider as well.
Okay, perfect. Thank you so much. Has anyone else got anything they'd like to add? No? Okay, so question for Michael again. Will I still be able to contribute towards my SIPP in the same way?
Yeah, it's, I suppose, really topical, given other points that have been discussed. I think until any changes come in, which is 2029, I think, like Liam's mentioned, it's business as usual. If I'm talking about being a contractor through Danbro as an umbrella contractor, I can still use my self-invested private pension. I can still put that money through salary sacrifice, and I can still maximise my earnings in the best way possible. I think the challenge we have got is, as people have mentioned, is that the changes that are proposed in 2029 may well go through. They may well not. We'll have to see what the government line up between now and then. But all it means is that the relief that the worker receives won't be as great as what it is now. It is still the most tax efficient route for contingent workers who are sort of employed through an umbrella model to reduce the tax efficiency. But I think for me, it's a case of yes, you can. Keep doing what you're doing if that's the route you're choosing to do now. And fundamentally, we'll watch this space when the government put in plans ahead of 2029.
I think the key thing, just off the back of what Michael said there as well, is, although from 2029, there might be, for a typical higher rate taxpayer, they're going to lose out on 2% of national insurance savings. I know we find in the contractor space in particular that a lot of the sort of the high earning guys will look to use the pension to bring their earnings down, and they will still use it to bring the earnings down. So we'll use a salary sacrifice arrangement to take their earnings down below £100,000 typically, and that would give them their personal allowance back. So it doesn't, the new national insurance hike, shall we call it, on pension contributions, it won't impact that at all. So for people who are in that sort of income bracket who want to use a pension contribution through the payroll salary sacrifice method to reduce the salary down, can still do that and benefit from a marginal saving of 60% plus. Yeah.
Mm-hmm.
Okay.
Anyone else?
That's good.
Okay.
Thank you.
So for Dan, how will the budget affect current umbrella contractors?
So I think briefly mentioned again, for current umbrella contractors, so we know there's no change in the threshold, so the government have frozen that for an extra 3 years up to 2031. So there's no threshold changes, which is good. The main impact specifically will be the minimum rate. So for those lower earners, they are going to get increased contracted rate, so increased pay. It will likely mean that they're going to pay more tax as some of them go into higher tax brackets. They kind of call it the stealth tax. So as inflation rises and general wages and rates rise with inflation, the fact that the thresholds have stayed the same does mean that there's going to be more of your money that is being taxed. So it's a way that they can say, well, we've not increased anything, but it is beneficial from a government to try and fill the hole that we're trying to fill ultimately. I think for umbrella contractors, that's probably the main thing that's directly impacting them.
Okay. Anyone else like to add anything? Okay. So another question for Liam. There you go. How are things changing for savers into cash ISAs from 2027?
Okay, so I think this one got plenty of lead up in the run up to the budget. So currently you can put £20,000 a year into a cash ISA. 20,000 is the total allowance that can go into an ISA each year, whether it's cash or stocks and shares or a mixture of that. What the budget has set out is that from April 27, the cash ISA limit for under 65-year-olds will be cut to £12,000. So practically it means that if you want to put more than £12,000 into an ISA after April 27, the rest of it will have to go into a stocks and shares product. So I'm not sure about the reasonings behind this. There's been a lot of talk about, I must mention actually, over 65 years of age, you're exempt. So you still get your full 20,000 cash ISA allowance. The Chancellor stood up yesterday and said the rationale for it was to get younger people investing rather than saving, because they'll get better returns in the long run, based on the information she gave out. To me, it just seems a bit confused. It doesn't seem consistent. It's another tinkering with the ISA system that it doesn't really need. My opinion would be it probably needs simplifying. Yeah. But the practical, the practical implications of it are very simple. That if you want to put money into an ISA after that time, you'll be restricted into a cash ISA after that time. You'll be restricted to £12,000 a year. Doesn't affect people who are putting money into stocks and shares ISAs, they can still go up to the £20,000 limit. But yeah, it's just another complexity, and I don't really understand what the benefit is, to be honest.
Right. Has anyone else got anything they'd like to add? Okay, Saudi. So what is the benefit of the first year allowance?
So let's think about capital allowances then for businesses. Usually, so if you remember during COVID, the government announced a super deduction, 130% rather, of capital allowances that could be claimed. That was initially known as the first year allowance. After the initial brunt from COVID, they reduced it down to 100%, and then it sort of died out. It's now come back for 40%. Now, if we're thinking about what sort of assets a company is purchasing, first year allowance is quite a restrictive allowance. You can only use it for something that is new and unused. Now, there are other capital allowances out there that they have not touched and touched as well. So we'll talk about a few of them. But essentially, we wouldn't really look at claiming a first year allowance in majority of situations. The first one we'd look at claiming is your annual investment allowance, which is £1 million. So any sort of asset that you're purchasing, if it's business related, so for example, new computer equipment, new factory machinery and so on, we would look at claiming the annual investment allowance first, purely because if we look at claiming the first year allowance, if you dispose of that asset or if you sell that asset, we're going to have to do something called a balancing charge, which means whatever your sales proceeds are on disposing of that asset, you then have to pay the tax on that. Whereas if we claimed annual investment allowance, there would be no balancing charge at all. There are a few situations where potentially we would look at considering claiming the first year allowance. Usually it was going to be if it's a new electric car. Otherwise, I'd probably still stick with the annual investment allowance. Now, as I said before, the annual investment allowance is £1 million. So we're talking about businesses that are buying new assets more than £1 million. So we realistically looking at your larger businesses here, your small to medium businesses, very rarely go to that sort of extreme limit. The other thing to note is your written down allowance. So this is where you've not claimed any annual investment allowance or first year allowances. Initially, you could claim an 18% relief on those purchases. That's now reduced to 14%. So just bear that in mind. But like I said, most businesses that I've seen will be looking at claiming the annual investment allowance for purchases anyway.
Perfect. Would anyone like to add anything? No. Okay, Michael. What changes are the government making regarding the ERB?
Wow, I suppose where do you start? The government had a deadline to roll out details regarding the Employment Rights Bill last year. There was a lot of talk around a number of different areas, and we could be on this for a number of hours to try and get through them all. But I think in terms of how these topics are relevant to our industry and to our business, I think the couple that really stand out are sort of trying to help and improve the gig economy. So you've got your Uber Eats and your worker statuses and your flexible workforce. And at the moment, that there seems to be three types of engagement models. So you can be employed, like we are. You can be self-employed, like some of our candidates are, or you can be a worker. Now, the government don't seem to like that worker engagement because there's very little rights, very little support for them types of workers. And we don't want to be seeing these people getting sort of work and not getting paid for it effectively. So I think from ourselves, I think we are in a really good position where we've been able to provide payroll, we've been able to provide employment, and depending on how the government pivot, as we will move down the roadmap over the coming months and years, we've definitely got the right service, the right product, and the right opportunity to help businesses grow and adapt to these new changes. There's a lot of talk around day one worker rights as well. So you've got sort of employees who potentially have to go through a probation period of 6 months, typically 9 months, where they then get employment rights and employment benefits, and the government are saying that maybe they should be entitled to a lot of this from day one. So the government are trying to become a lot better in terms of getting workers and people a lot more rights and a lot more benefits from the offset. I think businesses, on the other hand, I'll be trying to think, well, how do I absorb all of that risk from day one? Mm-hmm. You know, where's the cooling off period if I've made the wrong hire? And, you know, fundamentally, there's got to be a balance. And I think that's why this Employment Rights Bill is such a huge piece of work. And it definitely won't be a short-term thing. We'll be talking about this for probably the next 2, 3, 4 years. So they're making starts on certain areas, but I think it'll be a to in and a fro in and consultation on a number of these things.
Would you like to add to that?
Yeah, just to add, like, it again, similar to joint and several liability, it's a big thing that is not getting recent headlines, but it's still up and coming. I think you touched on it. The main thing about the Employment Rights Bill is you just got to keep your eye out for it, because the detail is yet to come. They're still going through the frameworks and the legislation. Something will come, but I think it's just giving the market a bit more of uncertainty, similar to the minimum wage increase, which is getting businesses and directors to actually look back, relook at their portfolio. How can we use the best of our allowances and make it most cost effective to actually push what we want, which is growth in the economy. And the government have put out a lot of stuff in terms of their investment areas of where they would like to see growth. So they're definitely trying to put more jobs out there. But yeah, it's a bit hesitant, and we're keeping our eyes out on the Employment Rights Bill. We're trying to get up-to-date legislation and how we can best advise our clients. But yeah, it's just very much like, don't miss it because of everything else that's happening, but you just need to keep your eye out for it.
Okay, brilliant. Would you like to add to that, Michael? Okay. For you, Dan, last question of the table. Is it less beneficial to be a limited contractor than an umbrella contractor now?
So, I guess in the temporary market, like as a group, we do both sides. So it's gone through loads of changes. Like if we go back quite a number of years ago, the contractor market was mainly going limited, self-employed and working for yourself. Then there's changes that have come in. So we've got IR35, which is the government's way of actually just trying to make work more fair for people who are contracting, but people who are also employed, to have similar types of roles to be paid the same and a bit more fairly. Obviously, with this recent budget, it's not really affected employees, as that's not really changed. But like you say, like the dividend tax and the more limitations around limited companies and what you can get. However, like if you're looking purely for money, it's still more beneficial if you can to go limited. It's just probably less beneficial than it was with some of the recent changes. But ultimately, it's the government's intention is, okay, what is your worker status? Like, is your contract fulfilling their SDC assessment, so supervision, direction and control, for you to have PAYE tax, and are you best suited for, if you can go self-employed, I think we would all recommend that's the best economically for yourself. So it's just slightly less beneficial now than it was, but it's still the most beneficial way. But it's really important because of everything else that's happening in government. They're focusing on compliance. They're increasing spend to go after actors that are trying to undercut, not pay the right amount of tax, and they just want all of that fairness. So it's definitely more beneficial, but you do really need to be careful that actually, with all of these rules in place, can you actually go limited?
Okay, perfect. Thank you, guys. Saudi, what would you like to add to that?
Yeah, I think it's not sometimes it's not just as simple as looking at what income have I got and what taxes am I paying. I think as a limited company, what other benefits you have to sort of think about is not just the means of which you can take the company out, but as a limited company, you can claim expenses. As an employee, you really can't. It's just a technicality in the way they do some of the wording. Is it absolutely necessary for the business or as an employee? So one thing to sort of worry about is, for example, your travel. As a limited company, you're going to be able to claim back your travel. So that means your travel costs have now become a limited company expense. Whereas as an employee, you're not being able to claim that as an expense. So your profit levels of what you would be taxed on as a limited company are already going to be a lot lower than they would be as an employee. Then we've got to think about what other means have I got to take money out of my company. So the usual routes would be salary and dividends, but we've also got annual events, we've got trivial benefits, we've got allowable costs such as mobile phone, which you're allowed one per employee. So all these factors also get involved, but because of the complexity, they do sometimes get missed out. Even when you're looking at closing the limited company down, if you are trading for 2 years, you can even look at claiming entrepreneurs relief or business asset disposal relief, as it's now called. So all these sort of things do need to be considered as well. But if you can get a limited company out of it, that would be the route to take more often than not.
That's why you should use Danbro Accounting, because we can help you with all of that. But on that, so I just wanted to clarify.
Do you want to help in sales now?
That's your job, Michael. I just wanted to clarify. So as a contractor, when you're inside IFA5, PYE, you can claim expenses, but it's just so difficult. There's so many rules and checks that you have to go in. It's like, is it absolutely necessary? Is it wholly and exclusively for the purpose of your assignment? So it is a very risky area for anyone within this industry to allow to offset for tax, because you've got to tick a lot of boxes, and ultimately where they're protecting you so you don't get a tax bill at the end of it. So you're definitely right. The one of the big things is the expenses you can put through a limited, which you really can't, or you probably should avoid as a PYE contractor. It's not to say that you can't, there's just a lot more hoops to go through.
Thank you for joining us. Thank you for all your insight. And for more support, please get in touch with someone from our Danbro team.